Okay, let's just start with a number that should really make you sit up and pay attention. 91 times earnings. That's the crazy valuation Polaroid was trading at back in 1972. It was what they called a one-decision stock. A company so good, so dominant that you just buy it and forget about it. The price didn't matter. Or so they thought. And then reality hit. The stock completely collapsed, falling a staggering 91%. Turns out the price you pay matters. A lot. And this isn't just some dusty old history lesson. It's a huge warning about what can happen when just a handful of can't-miss stocks seem to be the only game in town.
And that really brings us to the big question we're tackling here. Are we seeing a repeat of that same dynamic today? Is your portfolio, maybe without you even realizing it, actually trapped in a playbook from a totally different era, an era that, frankly, ended in a train wreck? So, here's how we're going to break it down. We're going to look at the spooky echoes from past market peaks, dig into what we're calling the modern concentration trap, and then we'll dissect what a market collapse actually looks like. After that, we'll ask the big question, is this time different? And, most importantly, we'll hunt for clues about where the next bull market might be hiding.
All right, let's jump into those historical parallels first. Because if you've been watching the markets for a while, what's happening right now probably feels, well, a little too familiar. I mean, the similarities in the big picture economic setup are just uncanny. Back in the late 60s, right before that Nifty 50 bubble popped, what do we have? Massive government spending, a surprise war, an energy crisis, and inflation that was starting to get out of control. Now, fast forward to today, COVID relief, another surprise war, energy shortages, and surprise, surprise, runaway inflation. It's like history is rhyming, loud and clear. And it's not just the macro stuff. Take a look at the market itself. In '72, those elite Nifty 50 stocks were trading at more than double the valuation of everything else. Today, a tiny group of tech giants, the Magnificent Seven, have created the exact same kind of two-tiered market. That massive valuation gap between the darlings and the rest, that's a classic red flag. And this quote just nails the psychology behind it all. It's this belief that certain companies are just invincible, that nothing bad could ever happen to them, so there's literally no price that's too high. That's the kind of thinking that gets you to pay 91 times earnings for a company. So when you hear that kind of talk today, your alarm bells should be ringing. So, okay, how does this all translate into actual risk for you today, especially if you think you're playing it safe with things like index funds? Well, this brings us to a really critical idea we call fake diversification. You see, you might own an S&P 500 fund and think, great, I own 500 companies, I'm diversified. But here's the catch. Because those funds are cap-weighted, the biggest companies take up the biggest slice of the pie. So your performance becomes almost completely dependent on the fate of just a handful of mega stocks. You're not diversified, you're making a massive, concentrated bet. Let's make this even more real. Think about the classic safe 60-40 portfolio. Well, when a huge chunk of that 60% in stocks is concentrated in tech, your portfolio is not balanced at all. It's actually more like a 70% bet on what we call long-duration assets, basically growth companies whose big profits are way off in the future. And those are the exact kinds of investments that get absolutely hammered when interest rates go up. So let's look at what actually happens when one of these bubbles bursts, because it's not a slow, gentle leak. It's a violent reset. The numbers are just brutal. A Forbes writer at the time said the Nifty 50 were basically taken out and shot one by one. Polaroid, down 91%. Avon, down 86%. Xerox, down 71%. And remember, these weren't some sketchy penny stocks. These were the absolute blue-chip, can't-miss leaders of that era. But here's the part that people often forget, and it's maybe the biggest risk of all. It wasn't just the crash itself. It was the long, painful aftermath. These stocks became dead money for almost 10 years. Even if you were tough enough to hold on, your money went nowhere while a whole new bull market was starting up in other parts of the economy. That's a devastating opportunity cost. Okay, but we have to be fair here and play devil's advocate. It's easy to just point at history and say it's all going to happen again. But what if things really are different this time? What if the US economy today is just fundamentally stronger than it was back then?
This is the argument you hear everywhere right now, right? It's the consensus view that the data has changed, the economy is structured differently, and so the old rules just don't apply anymore.
And you know what? The argument is a pretty good one. Unlike the 70s, today something like 95% of U.S. mortgages are fixed rate, which shields homeowners from rate hikes. People are sitting on huge piles of cash, and corporations locked in cheap long-term debt for years. Plus, our economy is now 70% services, which isn't as sensitive to what the Fed does. So maybe the U.S. really is impervious this time. Okay, let's grant all those points. The US economy is more resilient. But, and this is the most important pivot in our whole discussion, a resilient economy does not mean the same stocks will keep leading the market. In fact, if you look at history, it usually means the exact opposite is about to happen.
So the key takeaway here isn't to run for the hills predicting a massive crash. It's about understanding that market leadership is about to undergo a seismic shift. The real winning play isn't about dodging a crash. It's about correctly anticipating this great rotation of money from the old winners to the new ones.
And guess what? We have the map. We've seen this movie before. Just look at what happened in the 5 years after the Nifty 50 peaked. The money fled those former darlings and flooded into what you might call old economy sectors. Energy, industrials, small caps, they all crushed the broader market. The new bull market was hiding in all the places that everyone had been ignoring for years.
So if that's the playbook, where might the new leaders be today? Well, the parallels point to a few key areas. Things like energy, which gives you real assets and a hedge against inflation. Small caps, which tend to be nimble and have a history of outperforming after these big cap bubbles pop. And good old-fashioned value stocks. Companies with predictable cash flows and rock-solid balance sheets that do really well when money isn't cheap anymore. And this isn't just some abstract idea. I mean, look at something like the nuclear resurgence. A single tiny uranium pellet holds the same energy as a literal ton of coal. It's a perfect example of an old economy sector that's roaring back to life because the world suddenly cares a whole lot about energy security.
So, this all points to a brand new playbook for investors. Step 1. You have to challenge that passive assumption that your index fund is truly safe. You have to recognize fake diversification. Step 2. Prioritize quality. We're talking real, predictable cash flows, not just exciting stories about the future. And step 3. You have to embrace active allocation. In this kind of market, being able to rotate between sectors is how you're going to find alpha. We'll leave you with this final thought. Even during the tough, inflationary 1970s, there were incredible bull markets for people who knew where to look. The key lesson from all of this is that there is always a bull market somewhere. The challenge, and the huge opportunity, is to stop looking in the same crowded places as everyone else and find it.